In our Cape Town studio now to talk about the strong performance of the South African bond yields in the first days of this year, Jonathan Myerson from Cadiz Asset Management. Good morning to you, Jonathan. These bonds rose, the yields were down to the lowest in 5 weeks and linked to the oil prices. So perhaps for the people who don't actually trade in bonds but need to know why this is important, explain what's been happening with our bonds.
Good morning. So first, just to remind the listener or the viewers that when we talk about interest rates declining, prices go up, and that's obviously been particularly positive in the last 10 days or so. The year started really strongly. Benchmark bonds in South Africa has come down by about 45 to 50 basis points, and that's really been a result of a combination of things, but it really comes down to the inflation outlook and the massive benefit of the really collapse in the oil price over the last 3 months or so. So if you think that we were concerned about inflation in 2014 kind of remaining above or significantly above the upper end of the inflation target, I think it's quite clear that in 2015, at least in the first 6 months or so, inflation is going to be significantly low and possibly below the middle of the inflation target, that being 4.5%. Now, so obviously the benefit of lower inflation suggests that if yields are at these kind of levels, the real return that you get from bonds is quite attractive. And I think just to make the point, in 2015 started on a really strong footing. The market's probably returned about 2.5% already in bonds in the first 10 days or so, and that's really unusual in such a short period of time. And if you consider that in 2014 the market returned in total just over 10%, 10 days at 2.3% is quite impressive. Also, I just want to make the point, I suppose, that despite quite gloomy outlook for bonds at the beginning of last year, bonds did pretty well, and in real terms returned around 4%, similarly to equity, which are slightly more volatile. So I think we're looking for continuation of strength in bond yields at this stage, driven by the global environment, driven by US Treasuries falling to below 2%, and that also been driven by European bonds of the better quality, German in particular, falling or trading around historical lows.
Jonathan, let's expand on that, because you've mentioned CPI being important, Brent crude, and you're also talking about global equities and how those bonds are currently trading. What economic data should one be looking at during the course of this year to have a better understanding of how this is going to impact on South African bonds?
Sure. Well, it really comes down to the most important thing for bonds must be inflation. And the reaction of the Reserve Bank to that inflation rate in its monetary policy decision. I think it wouldn't have been that long ago when most of the market commentators would have expected the repo rate to be maybe 0.5% or more higher, and certainly by the middle or to end of this year to be significantly higher than where we are now. With inflation being as low as it is, that is not likely. So really the kind of anchor for bonds is what the policy rate is going to be. The longer the policy rate remains at what is historically low levels, the better chance is that longer dated bonds will perform well as well, because they just offer the higher yield, and inflation being low suggests again positive and currently increasing real returns from bonds, which is I suppose the most important thing that the bond investor looks at, because bond investors generally want more certainty and more protection than say when they buy equities, at least with equities in the short term. Bonds generally will be more stable, although of course them too at times are quite volatile, as we saw even in December last year when they lost about 1.5% of their value.
Jonathan, sometimes bonds become far beyond the normal importance in terms of trading. I remember there was a period with the Eurozone where every morning we were talking about Italian bonds and Greek bonds and Portuguese bonds and Spanish bonds as a measure of what investors were thinking of those economies. And seeing that foreigners, the note here, 958 million rands worth, or 82 million US dollars, in buying South African debt yesterday. That's the most since the 29th. I'm not sure how much is that, and what does it say about foreign investors compared to their normal interest?
Well, I think that's right. I think the best kind of barometer as to the perception of investors of an economy is probably the yield on the long-dated bonds. And South Africa has actually performed reasonably well in that area, because if you certainly consider what happened in Russia, Ukraine, Venezuela, some other countries, the impression, it appears, of foreigners of the South African market has actually been reasonably good, because South African bonds actually performed not only well in absolute terms, but also relatively to these other markets. So right now, for instance, I think one of the important things about the South African bond market, which we sometimes kind of ignore, is the fact that while the other emerging markets have got very high exposure to dollar-denominated debt, which suggests that they could come under more pressure, as your previous guest suggested. As the dollar strengthens, the cost of borrowing for these countries and the cost of financing that debt increases. South Africa's got a relatively low exposure to foreign or dollar-denominated debt, and what's even more encouraging is that most of that debt is long-term. So even if the rand was to depreciate a little bit more, and certainly what we saw in 2013 and to extent in 2014, it hasn't really affected the perception of foreigners around South Africa. So South Africa's actually stood up pretty well, but I have to say that there are obviously risks associated to our really reliance on foreign capital inflows and on the reliance of global conditions remaining supportive for investors that are looking for high yield in emerging markets.
Jonathan, thank you so much for that. That was Jonathan Myerson, who is the head of fixed interest at Cadiz Asset Management.